So much about the theoretical aspect of this pair trade. You will get a number of videos in our website. However, so let me give you some small theoretical descriptions about this pair trade. So what happens here? So we'll be taking two counters, X and Y. So through some mathematical process, through some analytical process, we'll be finding out which one is costlier and which one is cheaper. So cheaper. So this process of identifying a costlier counter and cheaper counter will be done through some mathematical process. After that, after doing this analysis, we will be selling the costlier counter. Simultaneously, we will be buying the cheaper counter. So we will buy the cheaper counter and sell the costlier counter. So this is how the trade will go on. And this process of selling a costlier counter and buying a cheaper counter simultaneously is known as pair trade. Suppose if you are getting X and Y company and X is costlier and Y is cheaper, so simultaneously you will buy X counter and you will sell the Y counter. So this process, this combined trade is known as your pair trade. So how this pair trade analysis is being done? So Smart Finance's sole innovation is the beta decoupling technique. In my first book, what I have authored on the futures and options, so in that book I have explained this beta decoupling technique. This is my sole innovation on the beta decoupling. So here I used to find out the beta and how the beta is the relationship between relationship between these two counters X and Y. So whenever this relationship deviates from its normal relationship, so we used to say that one counter is costlier or cheaper. So based on that we need to initiate the trade. So that is called your beta decoupling. And if you want to learn more theoretical aspect about the beta decoupling, so you need to visit our website smartfinancin.com. So I'll just show you the link, exact link where you will get those literatures. So you need to visit to our website smartfinancin.com, and in our website under the futures and option course, once you click on this futures and option course, here I have given access the Sure Success free futures and option online course. So if you just go here, you will get the description about the beta decoupling, option price model, option Greeks. So many theoretical literatures you will get it here, and you will get more clarity on the subject. So but today we are just assigned with only half an hour time. So in that it is difficult to explain that beta decoupling. If you are interested enough, then you can go for that. Then we have specific ratios, Jensen's alpha, Sharpe ratio and Turner ratio. These ratios are being calculated using certain formulas. Definitely some formulas will be used. This is using beta, this is using interest rate, one ratio, and another is using the volatility along with the interest rate, and the third one is using the beta and interest rate. So based on this three ratio and the beta decoupling, we will be initiating the trades. So whenever you are comparing this X and Y company, if Jensen's alpha, Sharpe ratio, Turner ratio of X company is lesser than the Y company, I repeat, if Jensen's alpha, Sharpe ratio, Turner ratio of company X is less as compared to the company Y, then the company X is known as a cheaper counter and Y is known as the costlier counter. So now the trade process is you have to buy the cheaper counter and sell the costlier counter. But this buying and selling decision is not being taken at this stage while calculating Jensen's alpha, Sharpe ratio, Turner ratio or beta. One more factor is very important, that is called your correlation. So first stage of your analysis, you identified which is costlier and which is cheaper. But this costlierness or cheaperness of that counter may be due to some temporary correction, may be due to some temporary valuation on the counter. So you need to know one more factor, which is called your correlation. So this says that how this X and Y are related to each other, correlation. So this is a scale, +1 to -1, this is a scale. So this scale will tell you whether to buy and sell that counter instantly only based on the decision of Johnson's alpha, Sharpe ratio, Turner ratio, or you should buy and sell along with some option hedging, means the double hedging principle you have to apply. Option hedging, so that your position sensitivity is temporary and that may reverse back. So correlation parameter. So to conclude, your Johnson's alpha, Sharpe ratio and Turner ratio should give you some clear view which one is cheaper and which one is costlier. Simultaneously, excuse me, simultaneously the correlation parameter also will be giving you 0.6018 to 0.75. This reason if it is going either positive or negative. If the correlation parameter in this band, then only you can initiate a buy and sell trade without any option hedging. If it is above 0.75 or if it is below 0.6018, then you may think of hedging this one with specific option. So I have just told you about all this aspect of the pair trade. So let us do some pair trade. So in our software, we have given a pair trade software here, wherein you can just take 3 counters and do the analysis and get their results on that. So I have taken Bank Nifty, Axis Bank and ICICI Bank. It will be better if I can load the data once again, and after that I'll be just do some intraday analysis. So let me load the data once again. Once this data is being loaded, then I will do some intraday analysis here. So what it is telling me, at this particular time, the buying of Bank Nifty and the selling of ICICI Bank, it is recommending me. It is recommending me the buying of Bank Nifty and selling of ICICI Bank. Assume I am entering in this value 10,200 and 982. So let me enter this value. Initially let me enter a trade, then only I can able to discuss about the hedging parameters or the double hedging parameter. So for that, let me open off one Excel sheet. So I am just going to buy Bank Nifty at 10,203, buying Bank Nifty at 10,203, and simultaneously I am selling ICICI Bank 983 level based on the recommendation of this thing, and this is for intraday. And correlation recommends trade with option hedging. This correlation parameter again recommends me I must trade this thing with option hedging. So I am in the very first day of the settlement cycle now. I am very first day of the settlement cycle now. So what I can do here, I have sold 983, I have bought at 201. So let me go for some options. I'll be doing some option writings with this because my objective is for intraday. That too, my objective is limited to only intraday. I am not going to hold this trade for positional. So 10,200 call option, which is pretty good, 300 rupees, and sometime I will be taking the option stock ICICI Bank because I am in the very first day of my settlement. So many of those, so 900 and 880, 900, 880, 950, 940. So nearest will be 980 put option. I'm just going to convert it to a covered call, and so it is telling me that you should protect it with some options. So I am selling 10,200 call option at 300 and I am selling 980 put option at say 37, 35, 35, 35. So this is a trade I am taking for intraday. This is a trade I am taking for intraday. So you must ask me when I should book the profit in this trade. When I should book the profit in this trade. So normally those who are using this pair trade, they will be knowing it. The pair trade works well in positional aspects. So it has little bit of demerit in the intraday because most of the parameters of alpha, beta, Jensen's alpha, Sharpe ratio, they never used to recouple in a very short duration of one day. However, if you ask me how I will intraday basis, how I will book the profit, I am taking the volatility of these two instruments. One is 28%, another is 36%. 28 and 36. Bank Nifty is 28%. This is 36%. So this is annual volatility. So if I just divide it by square root of 365, I will be getting the daily volatility. So here this is Bank Nifty is 1.46. Again I will be putting in the square root of 365. So this is my daily volatility. Today I am expecting the ICICI Bank to move by 1.88% and Bank Nifty to move by 1.46%. So pricing terms, let me divide 983 multiplied with this one. So, and I have to divide it by 100. So then only I can get the actual price. So I am expecting some 18 rupees movement on this, and same time I am using each one lot. So 203. So each one lot I have entered, means I have entered in that. So 149 points movement in the Bank Nifty. So 18 point movement here and 149 point here. So let me put it in the using the Fibonacci sequence. When I will get a trend, my trend is going against me. I sold ICICI Bank. When I will conclude, my trend is against me. So for that, I will be taking 0.7 618 0.618 times of this one. So 11 rupees. Also here I will be taking 0.618. So here intraday basis we are doing. I am just explaining in the intraday basis because these features we have not added into the software because of its confusion, but again we will be enhancing it. We are working on that. So here the rough calculations I am just telling you. 983 I have sold. If it is going up by 11.55, 994 simultaneously 10,203 I have sold the Bank Nifty. If it is fallen by 92 points, 10,110. If both the things happen in this order, 10,110 it has fallen. Same time ICICI Bank has gone to 994, though it is a remote possibility. Bank Nifty to fall and ICICI Bank to rise, it is a remote possibility, but still, if it happens, I'll book the losses. Book the loss. Same time, how I'll book the profit? Because 149 point I am expecting here, 18 points I am expecting here. So my best case expectation will be 983 minus 18, and my best case movement will be 149 or 10,203 added with 150 points. My best case scenario, 10,353 it should go, and this one has to come down to 964. This is also a remote possibility, but this is a best case scenario wherein I will book the profit. So wherein I will book the profit. So this is how I should book my losses and book my profit, but this is a best case, but this also may not happen. It has a remote possibility. Reason is Bank Nifty rising, same time the ICICI Bank falling is a remote possibility. So what is the most possible outcome? Most possible outcome will be ICICI Bank Nifty rising to 10,353, simultaneously ICICI Bank also rising to 994. So this is a expected point wherein I will book the profit. So these price points I have taken it from the daily volatility with its maximum projections. So you must say that I have sold it at 983 and 994 I am booking the losses. But this 36 rupees you have also, 35 rupees you have sold a put option. That could have decayed to around 25 rupees or 26 rupees. So another a couple of points you will be recovering from that. So in no way you will be making a huge loss for intraday trade. So this aspect we have discussed in the intraday trade. So now if you just see 30 points we have just gained it here. 2 points, 3 points we have gained it there in the ICICI Bank. So neither we have made any profit nor we have made any losses. This is for intraday trade. So I repeat once again, Bank Nifty buying and selling ICICI Bank recommended with option hedging. Why? Bank Nifty and ICICI Bank is having a correlation of 0.96%. So which is a beyond our projection, 0.60, 0.75 above. For that we have to hedge it. We have sold a 10,200 call option and 980 put option at 35 and at a price of 300. So because it is the first day of our settlement cycle, so we are expecting the profit booking point to be 10,353 and 995. Or one more point also we can get it for the profit booking. Either Bank Nifty should fall down to here, same time this also should fall down to 64. This is also expected. This is the points we are expecting. So wherein we will book the profit for the intraday trade. So any questions in this? Any question or not? So here what happens? Percentage of unhedged capital, how much we are going to keep? So Mr. Diptendu is asking that. So here what happens? If your total trade value is 5 to 6 lakhs, here near about it is coming to 8 lakhs. So 10 to 15% you can keep it as a unhedged, not beyond that. So your total trade value is around 8 lakhs 20,000. But if you want to keep unhedged portion, so 10 to 15%. So 10% is coming around 81,000. So till 81,000 unhedged capital you can keep it, not beyond that. It won't be advisable. It may not give you good rewards. So 2 trades I have recommended for you in this option hedging. Number 1, for intraday we are buying Bank Nifty, which we have bought at 10,203. Sold ICICI Bank at 983, Along with we sold 10,200 call option and 980 put option at 35 and 300 respectively. This is for intraday. We are expecting the bank nifty to go 10,353 simultaneously. ICICI Bank would have gone to 994. Or second case expectation is bank nifty may fall down to 10,110 and simultaneously ICICI Bank should fall to 964. IDBI and IDFC I am recommending to buy 2 lots of IDBI at 55.75 and sell IDFC 93.35. So 2 lots IDBI buy and 1 lot IDFC sell. Currently correlation is pretty good, so you can, but it may change in future. So if you are 10 days we are going to hold it. So if you are not secured enough, so you can think of buying 60 put option. Same time if I can tell some 90 call option or IDFC, somewhat a dip in the money, IDFC, so 90 call option also will be trading at some price only 6 rupees or 3 rupees premium. So 3 rupees is too high, somewhat go in deep into, or else you can just, or else you can sell some options and form some strategies like that. So you can think of in this order also. If I'm just 60 put options, 2 lot, around it is 6 rupees range, 6 rupees and 25 paisa range it is trading, and you can think of buying some 90 call option at 6 rupees and something. This is the easiest hedge, but easiest hedging principle. So 6 rupees and 35 paisa it is quoting, or 6 rupees 50 paisa it is quoting. So 1 lot. So since 10 days you are going to hold it, so better to hedge it with some options if you like. And if you want that, yes, I'm paying some great amount of time value here, so you can think of some selling that also, some options like IDBI is having IDFC uptrend starts at 95.83 and at 95.83, and this IDBI downtrend starts at 53.16. So 53.95 it is quoting. So you can think of selling somewhat higher strike call options, like you can think of 90 you have bought. So what about 100 call option? 100 call option if you are selling it here, so if you are just sell 100 call option at 2. So anyway you are not sacrificing the time value. So and your value also 93 to 107 and 9 rupees you are getting in terms of time value, and 3 rupees you are paying in terms of time value, and same time also you can think of selling some put options. Sorry, I told you wrongly. So for IDFC you have sold, so with 90 call option, so you can say 80, around 89 its downtrend starts, 85 put option you can say. So 85 put option. So along with sell 85 put option. I told you wrongly. So 85 put option you can sell at 1 rupee 65 paisa. 1 rupee 65 paisa. So 8 rupees you are remaining, and still you have 6 rupees here. So for IDFC this is the thing you can do, because 10 days is a great time. During that time many things can change, and 60 put options you have bought, so nothing wrong if you can sell some call options of IDBI. So call options of this one, if I am going for 60 put option you have bought, so how about 65 call option? It is too low, so how about 60 call option? This is also 1 rupee 50 paisa range it is trading. So nothing wrong if you can sell 2 lots of 60 call option. This also you can do it. It is not required at this particular time, but still if you are feeling to hedge it, you can sell some call option at 1 rupee 55 near about 1 rupee 50 paisa. You will get it, so that you have not paid anything time value to the market. So you have not paid anything time value to the market. So time value to the market, rather you have protected, and you are going to get some good money out of that. Rather you have protected, and 53, 55 to 60, near about 4 rupees into 2 lots, which is 8 into 4, 32,000 of profit there, and here it is totally capped. So you are, by protecting these two ways also, you have near about expected gain around 32,000, expected loss because you have sold some options here and bought this thing, expected loss 3 rupees. So you have got some 650. Let me tell you the exact figure, minus 55.75. So 4 rupees here, minus 6.5. So 2 rupees 25 paisa plus 1 rupee 65. So into 8,000. So you have expected loss around 9,000 rupees. Expected loss if the trade doesn't succeed, doesn't move in any direction, expected loss will be 9,000. Rough estimate, exact estimate also you can able to do. Expected loss 9,000, expected gain around 32,000, duration of holding 10 days. Duration of holding 10 days. And since it is a 8 lakhs with the hedgings, I think the margin 8 lakhs 20,000 margin will be required for this trade, will be around 1 lakh 35,000 margin will be required. All that I have given here. This is margin required. Margin required is 1,35,000. Expected around 32,000. Expected loss 9,000 in 10 days holding period. When to book the losses? When to book the losses? If IDBI falls, because you have, so you have a put option, 60 put options. However, if IDBI falls greatly around 50 level, you can book the loss. Simultaneously IDFC also could have, yes, you can do delta neutral also. You can do delta neutral also. So here, if IDBI falls to level of 50, you can book the losses and come out. And if IDBI goes to level of 60, simultaneously also IDFC could have gone up. So level of 60 plus 61, 62 or 63, then you can think of booking the profit and come out. And by the end of February settlement, if it is closing above 60, and simultaneously whatever the level of your IDFC maybe, if it is closing above 60, then you will be at your maximum profit of 32,000. By end of February, if IDBI is closing above 60, then you will be at a maximum profit of 32,000. If it is falling below 50, then you should book the losses and come out. Both the counters need to be closed. Any